Hello, folks. Brandon Chapman with you today. It's another edition of the Thin Night video for Monday, August 1st. Man, we're in August already, 2022. The title of today's session is ISM brings market back to reality after Exuberant week. What's next? I say back to reality only that we're down, right? Because it's a mixed day. We're down about 0.25%. Nothing super exciting. We're testing resistance up here. If we look at the /ES or we look at SPX, I mean, we're wanting to push towards this kind of 4182, 4200 area. The VIX right now is pushing a little bit higher. We got resistance around 24. What's the next stage for the market? Are we really going to just squeeze higher, or are we going to start to acknowledge what we probably know as we're angling towards or already in recession? My take for the last 4 months have been we're in recession or going to recession. So this is nothing new for me to say, but I would argue we're in recession, particularly after June, and we're not angling in a great fashion. But when so many bears are going in one direction, does this mean that the market largely is priced in the negativity? So we'll kind of talk through that, as well as look at some other symbols like in RIVN and NKLA, Taiwan Semiconductor, Micron. We'll talk about TIPS treasuries, Pepsi Monster, and EEM in this video. As we look at the S&P again, we saw the VIX skew right now. We're not talking about a high skew. There is this kind of reluctance to want to hedge at the moment. There hasn't been a lot of desire to hedge, but we're finally starting to see some premium selling and pushing down the VIX last week. That's reversed a little bit this week, today, but I'm expecting this trend to probably continue as we edge towards 20. But we need to recognize that the air is increasingly getting more and more thin as we're up here. And then we're looking for the pullback. And the question is the pullback like this? Is it like that? Or is it a small one like that? Or is it a one day and then it just rallies back up again and we break through 4,200 en route to 4,600? This is what we don't know. All we can do is look at significant levels and say, hey, if we break this, we're going to the next level. What's that next level? Probably around 4,400, 437.50 or 437.50 on the SPX. So as we look at this thing, all we can look at levels and say, okay, if we take that out, 4,300, maybe 4,375, then 4,500, and we keep inching higher and higher until we get back to 4,800. But that's a long ways away. And if we look at what happened in the last week, that's probably not the odds-on bet that we're just going to go vertical. I do think we're at a point where we have a two-way market where we'll probably have some back and forth going in whatever direction we're about to head. Now, today's ISM data didn't really do a whole lot, right? We're down slightly. We rallied. We retested Friday's high. Kind of similar top highs and similar lows today. But the data wasn't amazing. So just taking ISM Manufacturing data for today, 52.8 versus 53. We're still in expansion according to the ISM. That's a little bit higher than estimates of 52.3. But it's where you start to get into, for example, new orders, it becomes more difficult. Down 1.2, 48%. What does that mean? If you're less than 50, we're in contraction in terms of new orders. Employment in contraction at 49.9, albeit up 2.6. Employment's one of those areas where, I'm thinking, man, we're going to start to see more slack in the economy on the employment front. If we're going to start to see fewer new orders, if we're starting to see, consumers pull back on more durable good type items and other things, or in services, for example, we may start to see some softness enter into the jobs numbers. And we'll get a jobs number coming up this Friday. We'll see if it's surprise to the upside or does it surprise to the downside. But companies like, Barrett Business Solutions, some of these employment-focused companies, Workday, Korn Ferry, a lot of these companies have done well over the last month or so. And again, this was a big focus on my coming into the year. And I think we're starting to see some of these companies start to turn around and do relatively well over the last couple of months. And so I'm thinking, hey, we may start to see more slack in the economy, particularly for employment. And that's going to be coming out from some of these, again, failure to generate new orders. So we're seeing that's in contraction. Inflation did come down a bit, but it's still at a 60, albeit at a 2-year low as far as the ISM inflation number, and largely due to energy, but it's still at 60. Very high number for seeing slack in other areas of the print. And we also saw that we're down, that was the lowest since 2020 in terms of the ISM manufacturing number. We're down 3 months in a row. So again, we're seeing this downward trend in activity-focused indicators. ISM is going to be more leading than GDP will. So again, GDP, Atlanta Fed lowered its expectations for third quarter GDP. How many negative quarters in a row before we start to acknowledge, are we in recession? The fact of the matter is, you don't have to define it as a recession as an investor. It's semantics, right? We can look at the bond market, and the bond market will give us a pretty good indication. There's the closing bell. Will give us a good indication of whether we're angling towards recession or angling towards growth. Notice how Treasury yields are falling. And in fact, if we look at this from a yield curve perspective, I'm switching. I forgot to delete that one. U.S. Treasury yield curve. We got to take the price as a percentage off, and we should be good. What you're seeing out here is that what? 5 years above the 10-year, 5, 10, and 30 are all clustered together. Look at the 3-month T-bill starting to decline a little bit here. The Fed may try to walk this back, but they've actually taken away their guidance in terms of interest rate policy. Why? They say they're data dependent. And what the bond market's telling you, the data means what? The data is we're going to recession. That's what the inverted yield curve gives you. And by September, we'll probably see this push to an inverted yield curve as they're expected to raise 50 basis points. And maybe they're done at that point. Again, is that the market's pricing a little bit more out of it. But again, as we start to look forward, if the market starts to soften, the economy starts to weaken, and the federal government starts to expand their deficit spending, what are they going to do? Keep raising rates as the government goes from maybe reducing the deficits this year to $1 trillion to $3 trillion next year? It's going to be interesting, right? They're in a pickle. This is the Fed conundrum. There's no way out of this box as gracefully. So all they can do is pretend that they're okay being in the box, and they know what to do in the box. But anyway, look at the TNX. This may be one of the better investment opportunities in the near term. When I say better, it doesn't mean the highest yielding in terms of return. What it means is that you have the return relative to the risk. And I'm talking something like TLT. And this is something I've been talking now for over a month as an area of opportunity if the Fed starts to go on hold. And again, we don't have confirmation the Fed's on hold, but we're getting an indication the terminal Fed funds rate is not going to be 4.5%. Never thought it would be, but it was being priced in. Now we're backing off of it. And what's happening? We're seeing mobility in TLT. If the Fed starts to cut SHY, or the expectations are going to start to cut soon or be on hold and then cut, this may create some upside opportunity as well in SHY. And again, I think I've talked about this before in the video, but again, I think everything we're seeing every week is confirming that the Fed may not move as much. And what that's doing is it's creating some positive movement in stocks. We're not seeing the retail side of the market selling, right? We're not seeing people sell off in their mutual funds so far this year. We've seen hedge funds. We've seen a lot of these funds raise cash levels. We've also seen a lot of short interest in hedge funds. So what does that mean? If there's a lot of high short interest, it means that we could see further levitation as these kind of garbage companies that maybe should go down don't. And we've been following high short interest companies for a while now, looking at that as a source of opportunity. Now, you look at today's movement from a sector level, energy is at the bottom of the list. Libya maybe increase and starting to show some output. Again, recessionary type indications. demand, killing demand, supplies back in that 5-year range, doesn't materially change things with regards to energy. Now we look at forward/CL, we're looking at oil specifically. Oil's retesting support today. We look at the product depth for oil. Notice the line is flattened a little bit. This is today. That was last week. So we are seeing a little bit of a flattening of the curve, right? The concerns over demand are certainly wearing thin a little bit on the demand for oil and specifically the term structure of oil. But we're still in backwardation at the moment. We haven't seen this start to flip over here like you'd normally expect to see. But we are at a very key level here at around 95. And we start to take out these lows. Again, this is not a good sign for the economy either, by the way. Again, this could be a very indicative of demand destruction. We have real issues on our ability to raise supply. Read some articles over the week talking about the lack of equipment to open up a new well. We got to put equipment there, right? Lack of equipment to increase production. Are they being truthful? Maybe, right? But the idea is we're seeing a lot of lackingness in many parts of our economy as shortages persist for some goods. What we did see is that some of the shortages in some of the more cyclical parts of the economy are not as short. But food and energy can't be printed, right? You can't just, it's hard to kill it with just a down cycle economically. But they may have been doing some more damage here to oil. We'll have to see. But again, watching for rebound, because again, we're only down 2% today. Some of the ones we've been following is Antero. It's taking a breather right now. Look for the breakout. We're watching Tellurian, which is more natural gas focused. Again, taking a breather. These aren't bad things to look for and looking for that breakout, right? RIG has its earnings coming up, I think tomorrow. In fact, aftermarket close today. So again, what does this company do? After hours, I guess hasn't really. We just closed like 6 minutes ago, so a little early on that one. But the point is, the air has been to the upside as you look at some of these other companies in the similar industry. There's Bohr. Looking at them on Friday. WTI has one coming up. I think Res already announced it had a pretty nice gap higher here following its earnings. National NOV had a big move on its earnings. So, right now, these companies are making a lot of money. A lot of them are. Look at Exxon running away with it. Testing the 61.8. We start to break 97.50, maybe going back to 105. So take this as a little respite and maybe as an opportunity to reset, because energy was the best performing sector last week from Friday to Friday. So again, interesting. Now, Staples, it's making a move today, right? Walmart's a company that took a major hit last week. It's been ripping higher. I went over an unusual option activity trade last week in Walmart on the 27th. Again, trying to close that gap here. It's closed the gap, folks. That's how benefit XLP and make up some of the losses as you look at other more traditional, like Campbell's Soup's making a leg higher, right? Kellogg's making a leg higher. So a lot of the consumer stable space pushing towards highs, although, again, are they attractive at this level? Again, I think the risk doesn't necessarily warrant the reward. But one of the elements of strength to the market where everyone's kind of skewed more bearish is high short interest companies, a la companies like Nikola, for example. Is Nikola a good company? No. I believe they're probably laying people off. Yeah, they manufacture hydrogen. I believe they outsource a lot of their vehicle production. Stocks ripping today, right? In fact, you look at the surge, kind of the latter half of the session here, got a nice move. A lot of this being precipitated by short term. Again, a lot of turnover on this 5 August rolling out to the 12 August expiration. So we're creating this pressure of rolling out from the $6 strike price to the $6.50. And again, kind of keeping the pressure on. You start to break $6.50, you create an opportunity where we may have a chance to run. So I was talking about this during my session today in NKLA. Again, they don't have to be great companies, but they have significant short interest. Another RIVN, right? RIVN today, and this is on kind of that weekly options here for 5 August. But again, a lot of turnover out here, right? A lot of calls being traded. Helps create gamma potential. $40, does it carry over a lot from today to tomorrow? So we start to hit 40, start to break through 40. We could see a big catalyst to drive these in the future, drive these higher, for example. And again, you'll notice the vol skew is favorable out here to buy here and sell out here rather than just going way out of the money and buying a $40 call. But these can be some lottery tickets. Again, it's based on the premise that high short interest companies may not be done with their short squeeze at the moment. And again, we kind of look at this here. You'll see it's pretty balanced between up and down. Stocks for above 5%, below 20% for most of those. You look at high short interest above 20, on track today. Huge move. But why? Short squeeze, right? So you have these names and they get these big moves here. RMO, Romeo Power. Probably could have seen that coming last week with a lot of power companies starting to see a bit of a move, like a MAXN, for example. MAXN, battery storage. Let me try this. Let's try this again. Battery storage, again, moving last week. A lot of the solar power companies, SPWR, for example, SolarEdge, SEDG. Again, these are overextended in the near term, but again, may benefit from government policy regarding these stocks. So the idea that the companies have high short interest or tied to government spending can be very opportunistic right now. The ag space that we've been talking about for a couple weeks now, that's right, AG. I meant to go BG. Bungie, after dipping on its earnings, it started to rebound the last couple of days. And so you see these opportunities where, we sell off, but we settle in, and then we start to rally. Companies like Archer Daniels Midland, right? Companies like Mosaic, CF Industries, right? And these some of these are pausing here today. It could be the pause that refreshes. So again, continue to look for those upside. Tanker companies or ships, Nordic American Tankers starting to catch a bid today. TNK still ripping after we started to kind of talk about this space a couple of weeks ago. We're starting to see more shipping of product globally. So again, there are areas to be bullish on in the market. It's just a matter of those areas are getting smaller and smaller. One of those is maybe getting smaller is in the semiconductor space. Semiconductors are a leading indication for technology. Notice Taiwan Semiconductor was trading in a channel, started to break out here. Let me just bring up the volume. Looked like things were maybe starting to change after the earnings. We're starting to see a little bit of deceleration in the move. We're seeing a gap down today on high volume. We ended up relatively balanced, but we start to take out today's low. We may be looking to retest our lows again. And that's what's interesting with Taiwan Semiconductor. As we look in the August expiration here, you'll notice something, right? The 83, and there's others that kind of added in here. An 83.74. It's these two strikes here. Buying the 83, selling the 74 down here. That's a 9-point spread, benefiting from very favorable skew. Buying 43%, selling 57%. A 9-point spread, 74 gets you back to prior lows there. You risk about $1.50 to make what? $7.50. Very high reward to risk. You could give yourself a little more time. You don't have to go that wide if you're doing it yourself, but it's an indication of time frame and magnitude and direction, right? Looking at a retest of lows in the coming weeks. Micron as well, MU. Micron higher today, but faded from the resistance or the prior high here. You might want to look for some follow through tomorrow with this, but as we look at some of the activity in Micron today, it was a weekly option in here at the 61 strike. You can kind of see some out here as well. But again, some put activity starting to pick back up on Micron for weekly. Again, this can get faded a little bit, but again, look for some follow through and pushing through 61. And again, where could we go? We could end up retesting our lows again about 53, 54. TIP. Now, the Fed has kind of discontinued its guidance in terms of interest rate policy. And yet we're seeing TNX, this is their 10-year Treasury yields, continue to fall 2.6%. What does it tell you? Is the Fed going to end around 2.5 to 2.75%? Very real possibility. If they move in September the way they're expected, we will see a fully inverted yield curve, 3-month above 10-year, above 30-year, right? So again, this is an opportunity. This has a little catching up to do. There is some opportunity being long something like TLT, for example, right? Today, we're seeing TIP. This is Treasury Inflation Protected Securities that's been benefiting by the decline in interest rate expectations, but today down a bit. But more importantly is this. We'll look at the September here, right? In the September expiration, selling 60,000 contracts at 115, buying the 117, thinking, hey, we may have a chance of downside to 115. If you got some spare margin lying around, it's a very low volatility product. But this, right? You look at this, you'll see it's basically put on for no cost. So all they're saying is, what if inflation expectations start to come in? I mean, certainly the ISM data suggested that lowest in 2 years, still high at 60. But one of the things that I follow is TIPS treasuries against standard treasuries. So plus IEI, they have similar durations, which means they're impacted by changes in interest rates very similarly. I'm bringing up a study that's on the thinkorswim platform called the pairs ratio. And I don't care about the price chart here. I'm looking at the relative strength line. Recently, what have we seen here? We're seeing inflation expectations starting to pick up in the last month, albeit off of low levels. We're now seeing as the Fed is looking to change policy, people are expecting, traders are expecting them to go on hold earlier, even though they're kind of decrying that a little bit. Expect him to go on hold a little earlier. We may see this push down here, favoring treasuries over TIPS. There's another way to look at this. Make sure I got the right one. A 5-year break even. This is the Fred database for the St. Louis Fed. Notice how this has been rising over here since when? About July 6th. As inflation expectations rise, generally that favors stocks. Saw the same thing back here in February, right? And we began to see a breakdown in April. A little rise going into June. But if we take the difference between the yield on a 5-year TIPS treasury and a 5-year treasury, what you'll get is the implied inflation rate. It's not perfect. What we're seeing here on the chart is a ratio versus a spread because we're taking ETFs, but it's not too dissimilar. And again, I was reading someone following that to see what is the Fed going to do. My thought process is if this starts to come in, what does that mean? They're looking for more disinflationary pressures, downward pressure on the market. Right now, we're seeing inflation expectations kind of pick up just a little bit, which is positive to a point for the equity markets. Okay, but you might hit a certain point up here at 3.6 or here at 3.13, where all of a sudden we're pricing in a lot of inflation. Anyway, so I thought that was kind of interesting today. Stock last week that we were looking at in my session was Coke on Tuesday, anticipating a retest of 66. Pepsi today kind of tested its projection we had from last week up here at 177. Now, what you're seeing is weekly call activity trying to create some gamma and squeeze higher here. It kind of wilted a little bit from the highs, but getting stifled at the resistance around 177. Look for this to maybe start to peter out and look for a reversal. In fact, there was in the same industry, MNST, Monster Beverage, testing resistance up here. We're looking at getting maybe to 93, maybe pulling back to 90. Bearish trade today in Monster Beverage. Got to find it here. August expiration in here. 97. So buying the 97, selling the 90. What are we looking for here, right? Looking for a pullback towards the 61% retracement of the most recent upswing. So again, look for some traction below today's low. Earnings are coming up as well on August 4th, but we may be looking for the staples trade in beverages to start to stall out here just a little bit. Finally, emerging markets. Again, stronger dollar. If the market starts to experience some more bearish pressure, UUP is one way to kind of track the dollar against the euro predominantly. Dollar showing some strength here. I like to dollar showing some weakness here. Aussie US dollar, right? Aussie's been strengthening recently. I use this more as a proxy for emerging market currencies, and particularly China, since there's such a close tie between Australia and China. What we're seeing right now is the dollar's been weakening a little bit, and it's even been favoring gold, right? Gold's moved higher over the last 4 days. This may start to turn, right? If the market starts to experience a bearish turn, we could see the dollar strengthen again. And this creates extra concern for emerging markets, not just from a stock perspective, but from a currency perspective. So right now, to some degree, there's wind at its back as emerging market currencies are doing better against the dollar. What happens when that starts to reverse and we start to see a loss of value in emerging market stocks? In particular, this is heavily weighted to Chinese stocks. But as we look at today's trade, and we'll wrap up on this one with EEM, it's an August expiration out here. 52,000 contracts mostly bought. This stuff over here looks like it's being closed out. This is a new entry here. So it's a very actively traded product, but that's big, as we're probably seeing a lot of put options coming in. We'll see how much of that spills over, but 37.50 target in the near term is certainly not bad. Looking at a minimum retesting the prior low, maybe slipping a little bit below it as a near-term target. Not a bad setup here as well at resistance in a bearish trend. Anyway, folks, got to wrap it up there. It's been a pleasure being with you. We'll catch you back next week on the Monday video. Have a great week. Thank you.